The idea of economic collapse is often imagined as something loud and sudden, a dramatic break where everything changes overnight. Yet the reality tends to unfold much more quietly, almost invisibly, through small behavioral shifts that compound over time. And this is exactly what made the Great Depression so psychologically powerful, because it did not just destroy wealth, it rewired how people thought about money, risk, and security in ways that lasted for decades. Imagine an ordinary household at the end of the 1920s, where income feels stable, credit is becoming more available, and spending decisions are guided less by caution and more by expectation. Because when a system appears to be working, people naturally begin to assume that it will continue to work. And this assumption quietly becomes the foundation of financial behavior, even though it is rarely questioned. What happened next was not just a market crash, but a sudden interruption of that assumption, where access to money tightened, asset values fell, and uncertainty replaced predictability. And while the numerical losses were severe, the deeper impact came from the psychological shift. Because once stability is broken, the mind begins to prioritize survival over growth. And that shift changes everything about how money is handled. From a behavioral perspective, this is where scarcity thinking begins to take hold, not as a conscious strategy, but as an adaptive response, where every expense is scrutinized more heavily, every risk feels amplified, and saving becomes less about future goals and more about immediate protection, even if the actual income has not changed significantly. There is a simple mathematical layer beneath this shift that often goes unnoticed, because when uncertainty increases, people tend to hold larger portions of their resources in low-risk, low-return forms, which reduces exposure to volatility but also limits long-term growth. And over time, this creates a trade-off where financial safety in the present can quietly reduce financial expansion in the future. This creates a feedback loop where behavior reinforces outcome, because reduced investment leads to slower recovery reinforces caution, and caution continues to suppress growth. And what began as a rational response to instability gradually becomes a persistent financial identity that can last long after the original crisis is past. Historical data shows that individuals who lived through the Great Depression often maintained higher savings rates and lower risk tolerance throughout their lives, even during periods of economic expansion, which suggests that financial behavior is not only shaped by numbers, but by experiences that redefine what feels safe or dangerous. The interesting part is that this pattern is not limited to large-scale crises, because smaller, personal financial disruptions can trigger similar, though less extreme versions of the same shift, where a job loss, a debt cycle, or a sudden expense can cause someone to move from a growth-oriented mindset into a protection-oriented one, often without realizing it. If we zoom out, the system itself amplifies these behaviors, because modern economies rely on consistent spending and investment to function smoothly. And when large groups of people simultaneously reduce risk and increase savings, economic activity slows, which can deepen or extend downturns, creating a collective version of the same feedback loop seen at the individual level. This reveals a subtle but important principle, which is that financial systems are not just driven by capital, but by collective psychology, where expectations, fears, and habits can influence outcomes just as much as policies or numbers. And this is why periods of recovery are often uneven, because rebuilding confidence takes longer than rebuilding balance sheets. At a personal level, understanding this dynamic introduces a different way of thinking about money, not as a simple tool for spending or saving, but as something that interacts with perception, where the same amount of money can feel abundant or insufficient depending on the context that surrounds it. The lesson is not about avoiding caution or embracing risk blindly, but about recognizing when behavior is being shaped by past conditions rather than present reality, because decisions that were once protective can become limiting if they persist without reassessment.
Over time, financial stability is not just a result of income or returns, but of the ability to adjust behavior as conditions change, which requires awareness of both the external system and the internal responses it creates. And this balance between caution and participation is where long-term resilience tends to form. In the end, what the Great Depression teaches is not simply that economies can fail, but that the deeper and more lasting impact is how those failures reshape human behavior. And once behavior changes, the system that emerges afterward is never quite the same, because it is built on a different set of assumptions about what money means and how it should be used.